Well, good morning, everyone, and welcome to the February 2023 edition of the Ag Economic Dialogues. I'm Heather Gessner, the Livestock Business Management Field Specialist based out of the Sioux Falls office. And today we have Dr. Matt Diersen and Dr. Evert Van der Sluis going to share some information with us today. So in order to give them the majority of the time for the presentations, I believe Matt was going to lead us off, so I will turn it over to him.
All right, good morning, everybody. I have a few things, some random stuff really, that I just want to highlight and cover, and then I'll dig a little bit into where things are at related to crop insurance and a couple of related markets that are closely related to or use crop insurance information for some decisions. So first, I'm going to give you a little bit of a commercial. So I need to share a screen. And I want to highlight that recently on the extension webpage, we've been able to upload a video related to the Every Acre Counts program, and we anticipate adding some more videos. I just want to show you where those are located. If you go to the web and you go to the extension.sdstate.edu webpage, you'll see the pretty state bird there on the front. If we go to agriculture and go down to Every Acre Counts, we'll see that we scroll down on the homepage right now. We've got a short video, a 2-minute video there posted about what change looks like. I helped put this video together, and it surprised me how many times farmers and ranchers talked about dealing with Mother Nature and how to use that to your advantage. So that's there on the Every Acre Counts page. The other thing I'd like to highlight, just to circle back to some stuff we've talked about in the past on different dialogues. If we go to the Ag Business page and scroll down, you'll see that we've got this link for monthly cattle prices and basis levels. Those numbers were updated in late January, so they're there showing price levels and basis levels that you can use for planning purposes for the year ahead. So with that, just wanted to point out that those two resources are there. Take a look at a couple of upcoming dates and other things too. Crop insurance is right now, and that ends or uses planning prices determined in the month of February. So February 28th, you'll have the prices come to a close and set the final price levels and volatility levels, which dictate premium levels, and then with a March 15th deadline. So we're ahead of the curve a little bit on the crop insurance side of things in terms of, I'll give planning prices or expected levels. These aren't actual levels at this time. The other thing I want to point out is that next week there's the Outlook Conference, USDA Outlook Conference, which is being held virtually. That too would be just a good thing to take advantage of or be aware of and take a look at. So with that, I'm going to jump into my presentation. So I need to share again. Let's get to the right one. And Heather, if you would, can you see the, are we seeing the correct screen?
No, I've got 9 different slides showing right now.
Let's try this then. We'll go this way. How about now?
How about now?
Is that better?
Yes.
All right, thank you very much. So highlight just a couple things related to markets and then get into some more detail with crop insurance. Yes, this isn't crop insurance, but because I've talked about cattle a few times, just wanted to point out there was a cattle inventory report released recently. And in South Dakota, if you see way out there on the right-hand side, cattle inventory numbers at the state level, all cattle, all calves were down slightly compared to a year ago. So we're seeing some of that drought pressure carry through. the one category that jumped out is one that you need to back out or calculate out, and that's the number of feeder cattle outside of feedlots. So that's down, or that's down sharply. So calves and feeders were marketed a little bit earlier, taking inventories down. Cow numbers are down slightly compared to a year ago. I point that out as a prelude to this. Just yesterday, I received an update from the South Dakota Auction Agents, or South Dakota Animal Industry Board, giving a breakout of auction numbers through South Dakota sale barns, auction markets quarterly. So for the fourth quarter of 2022, you can see the volume there was down from a year earlier. So further confirming that cattle were kind of pulled forward and moved out of the market. You can also see that back here on the first quarter of 2020, the impact that COVID had reducing sales. So it shows up in the data, if you would. So just pointing a couple of things out that are some things we've looked at or monitored here in recent weeks. Now, back to the main thing, the crop insurance and where numbers and such are at there. So what you see for 2023 are projected levels or averages for the month to date for the spring crops. Winter wheat's in there as well, just to see that was had sharply higher prices back in the September, October timeframe. But corn and soybeans, for example, both are down slightly right now in terms of expected or projected harvest price, which is taken during the entire month of February. You can see that spring wheat is down ever so slightly compared to a year ago as well. So price levels similar, slightly lower than last year at this time. So that's part of the story. The other part of the story is when we look at the volatility. Backing up and looking at winter wheat again, winter wheat volatility at 30% was pretty much off the charts in terms of very, very, very high volatility. Very high premiums would have been associated with that, even though the price level was, or some good news with that was the price level was up. We look at corn, soybeans, and spring wheat. They all currently have price volatility lower than the last couple of years. So with price levels being similar to a year ago and this volatility being lower, that should put downward pressure, or we'd expect to see crop insurance premiums be a little lower than a year ago because of that. So that lower volatility at the moment across those three crops also means the cost of put option coverage, things like that, would also be lower for corn, soybeans, and wheat. So big picture, prices similar, volatility lower. Bottom line, a little bit better news for those looking to offset risk or lay off the risk using crop insurance and related tools at this time. Let's do a little deeper dive into the different, the three different spring crops, focusing for the most part on corn because I'll point out that a lot of similarities across the three spring crops. If we take a look at what producers tend to purchase, if we look last year, just about 100% of the corn in South Dakota was insured with revenue protection. So for the most part, revenue protection without the harvest price exclusion. So you tend to see coverage purchased to give you the ability to hedge and have price coverage for the upside and downside with that revenue protection. So it tends to dominate. All the other types together amounted to just about 0% of the acres. So I don't see anything that would suggest any difference to be expected in terms of the type of coverage selected in 2023 versus what we've seen in the past. In terms of coverage level, this does tend to fluctuate just a little bit year in, year out, but for the most part with similar price levels and slightly better volatility levels than a year ago, If anything, I would see a little bit of a tendency to go with a slightly higher yield election in 2023 compared to 22. But you can see that 3.5 million acres were insured at that 75% coverage level on corn last year. So that's the yield election level. I think 75% of your bushels are covered by, or your APH is covered by revenue protection. So 3/4, it's a nice round number. And that would also be the case for soybeans. You tend to see that same pattern, some use of 70, some use of 80, but predominantly 75% coverage. And again, that could just be a little bit of a sticky level. It was easy just to select what was chosen last year, but there would be a little bit of a price rationale to say, yeah, that level continues to make sense or be a reasonable level to expect, and probably reflects a long-term trade-off between the benefits of the coverage, the cost of coverage at that level, and higher coverage levels really push you into the cost level goes up a lot to go from 75 to 80, and subsidy levels change slightly and such. So it's maybe just a longer run equilibrium type of level to expect to see. If we look at what's happened over the last 10 years with crop insurance, I want to point out we got a couple things going on here. The first bar, the dark gray bar on the left of the set of three would be the projected price, and then the next one is the harvest price. So if we look back here at 23 and 2013, 2014, the harvest price, the average during October, ended up being less than the average during February when you look at the futures price beginning and end of the crop insurance period. And we saw that same pattern held with smaller changes in 15, 16, 17, 18, and 19, and then 20, 21, 22, the harvest price, the price we ended up with, was higher than what was elected, or what the market was giving in February of that year. Now, I would expect that the futures market would be unbiased and that it would be wrong to the upside versus wrong to the downside. In equal weights over the long run, but you do end up with a little bit of persistence in some of the patterns as shorter crops and larger crops either weigh or don't weigh on the market. The other thing overlaid on here is the October cash price, and that would be the price received by South Dakota farmers using the NASS, National Ag Statistics Service, cash price. So when that's finally reported in November, it reflects the price in October, cash price received by all farmers. So I use that just to benchmark against or compare that to the crop insurance harvest price. So that would reflect the basis you would expect to see locally in South Dakota at harvest time. So again, back here in 2013, the basis was fairly narrow. Basis can be fairly wide, as it was in 2018 and 2020. 22, the basis was, I don't have the number in front of me, but that's why we don't have a price in here, or the expected price in here is using an expected basis. Last thing on this chart, just for clarity's sake, is the volatility level. And at the moment, that volatility is sitting lower. That's the right-hand side margin over here. So back to that basis. Here's that basis trend. So you can see that basis, or the discount of South Dakota cash price relative to the futures. That basis was fairly narrow in 2019 and 21. Last year it was about 45 under. And what I would just use for planning purposes for this year, I would use a 5-year average of that basis level. So I use the most recent 5 years. So for planning purposes, I'm just using 40 under. So state level, I'd say 40 cents under. So new crop sits there at 5.95 right now, and I'd lop 40 cents off that and say that's what I expect for a South Dakota cash price. And that's where I'm getting that number from, and why I'm using 5 years instead of 10 years. That's just the choice I made it knocks out the extremes and says, yeah, what's the recent transportation situation and whatnot to reflect basis levels. So 40 under on corn. Switching over, looking at soybeans, same general types of situation and patterns. Let's just focus on 2022. So the projected harvest price was above $14, a little higher than it is now. The harvest price came in a little bit lower than the projected price. And then the cash price was a little bit lower than that. So a relatively narrow basis last year. But if we use, again, the 5-year average basis, we can see that that current futures price running right around 1385-ish on the average of the new crop futures with that basis on there. We'll see that in the next chart, but basis will put you around $13. And we've got the volatility pattern. This year, that volatility is lower again than the last couple of years. So same general pattern for corn and soybeans going through. Here's that basis level. So basis narrow the last couple of years at harvest time. And if we use that 5-year average basis for soybeans, it's about 65 cents under. So again, what I would use for planning purpose, big picture. So you need to adjust that for your location in South Dakota. But this would suggest, yeah, you'd expect 65 under at the state level. We switch to wheat, same pattern holds there for wheat. Futures price is sitting about where it was last year. Volatility a little bit lower. The other thing with wheat, it is tied to winter wheat insurance, but there is revenue protection available this year for oats and rye in South Dakota. So something to take a look at if you are considering those crops. Those crops were commonly mentioned by our cooperating producers in the Every Acre Counts program as other small grain crops they're using at different times, sometimes as cover crops, sometimes as a crop they're trying to look at to enter into the rotation. So those are available with some revenue protection loosely tied to, I couldn't find all the details on exactly how it would play out, but loosely tied to the winter wheat price level and price election type of stuff. They're not using oats futures or oats options, which are very thinly traded. They're saying now we'll have to use some other price series to benchmark against. So they're using the winter wheat futures prices for that. Basis on spring wheat. Last spring, it was actually, or last harvest time was actually slightly positive basis. The 5-year average here is coming in at 57 cents under. So that's what I see big picture: corn, soybeans, spring wheat, other small grains heading into the critical crop insurance purchase decision time frame or time of year. Now, shifting gears a little bit, but staying with this crop insurance idea, we've got one, it's not a unique historical relationship, but something that we loosely monitor and just for big picture to get some idea of what might be happening with corn and soybean acreage in South Dakota. And for that, we look at the soybean to corn price ratio on the board or using the relative new crop futures prices to see if that gives some indication of where what the incentive might be to go with corn acres or soybean acres or some combination. So here is the soybean to corn price ratio backed out of the CME. So if you go to the Chicago Mercantile Exchange website and pull up either a new crop corn or a new crop soybean chart, you can throw a division sign in there. So I started with a soybean chart and then divided it by the new crop corn futures price. And doing that just gives you the price ratio. And here's the chart going back to middle of last, end of last spring. We can see that from harvest time until now, the general trend has been a higher soybean to corn price ratio. And I found a nice little corn infographic there, emoji, I believe, showing that if that price is moving in the downward direction, that would favor corn acres. If it's moving the upward direction, it favors, okay, it's salad dressing. It's the best I could do. I'm open to other suggestions for an emoji for the soybean crop. But if that ratio is higher, it's saying, hey, the soybean price is high relative to corn. We'd expect more soybeans to be planted relative to corn. Okay, so that ratio much lower than it's been the last couple of years. And recently it's been trending ever so slightly higher, but it's about 2.3 at this time. Armed with that information, we can throw that 2.3 into the longer run relationship between the relative futures prices during the month of February, the price election levels you observe with crop insurance. With crop insurance and those prices decided during February, what does that mean in terms of what we'd expect to see with acres at the state level for corn relative to soybeans? So here's that relationship over the last 20, 25 years at the state level. So this is US futures prices, relative new crop, soybean divided by corn price during the month of February. So that's going along the bottom. Last year, we were out here at 2.6. This year, we're sitting at 2.3. So the price of soybeans on the board, 2.3 times the price of corn. Last year, last couple of years, you've had a much higher soybean to corn price ratio at the state level that has influenced the prospective plantings of soybeans relative to corn in South Dakota. So that's the left-hand or horizontal margin here on this chart. So the lower the ratio of soybean to corn prices, the lower the amount of soybeans relative to corn. So with 2.3 sitting, that's where we're at the moment, we'd expect to see soybeans in South Dakota at 85% of the acres of corn. Now, don't know what the total number of acres is going to be, but relatively speaking, with the lower soybean to corn ratio, we'd expect to see a lower amount of soybeans relative to corn in the prospective plantings report, which we'll see the last business day of March. So all tied to how much of an incentive is the market giving? Is the market trying to buy corn acres, buy soybean acres? Is it being reflected in the futures prices? And does that actually carry over? Is it reflected in what actually happens with acres in South Dakota? And I get in fertilizer and relative costs and everything else, but big picture, this relationship tends to generally give an idea of what to expect or what you tend to see happen. So I don't claim that it's perfect, but it does explain about 76% of the variation over the last 20 years or so. So I would expect, because of this, with that lower ratio, we'd expect to see either relatively fewer acres of soybeans or relatively more acres of corn planted in 2023 in South Dakota. Is that clear? Maybe? Okay. So that's what we're seeing with that. The last little piece of newer information I'd like to share has been the general growth in short-dated new crop options. So these are options that settle at the last Friday that has 2 more business days following it for every month. And the price that it settles to is the new crop futures price. So I'm going to talk mainly about corn because that's what I've been looking at. And that would be the one. Corn and soybeans would both follow the same general type of pattern. But I've just focused on corn here for the short run. Short dated new crop options might be a cost-effective way to manage short-run price risk, but it needs to be specific price risk. It needs to be concerned about where new crop futures would be at a given point in time. So big picture, it might allow for some positioning in this time of year. So prior to when your crop insurance price election level has been cleanly or fully decided. So you might try to do something prior to crop insurance or prior to crop insurance being set. You might want to use options in the short run. Then when you get to, this is exactly what my price level is or how much revenue protection is available. Now I can use futures or other things to get you through the rest of the marketing year. Another reason to bring these up is that very recently here, the last few weeks in January, the Chicago Mercantile Exchange started listing and trading weekly short-dated new crop options. So there's been weekly options, which are still traded and they settled to the nearby futures price. But now there are weekly options that are listed and traded that settle to the new crop futures price. So going forward here for the time being, every Friday of 2023, you could purchase an option for a week or months ahead of time and have something in place for the settlement of new crop futures on those Fridays. So it makes my head hurt just a little bit to think about it. So to make it real for myself, I'm like, okay, let's look at this close one. There is a March OCDH3 that expires at the end of February. Well, that's a little bit before the crop insurance purchase deadline. But when you get to that late in February, it would sort of reflect where futures are kind of at because of the averaging that's done. That might not be too unrealistic of a settlement time to look at if you were trying to do some managing prior to that crop insurance being settled up. It has some volume. And then if we look ahead to the next one, that would be more logical for having a deadline after the crop insurance deadline. The April volume for that monthly short dated new crop option has much lower volume. So March is being used, even though it may not be perfect, but you get the general idea, I hope. The next one out there would be the May expiration. So that expires at the end of on April 21st. That is the first short dated new crop with a settlement or expiration date after the prospective plantings report. That has a fair amount of volume right now. And the next one would be the June acreage report, and that would be the August contract, and it has much lower volume. So you can sort of justify or see the story relative to the prospective plantings report at this time, and a little bit less so when you talk about the June acreage report. So thinking about how a farmer or a banker or other risk manager might think about this, is there specific risk compared to, say, that prospective plantings report? If that would move the market a lot one way or another, do I want to have a position in place ahead of that? Might be looking at that May short dated new crop option because the out-of-pocket expense for it would be less than using a normal December option. So that's the idea. Let's take a look at just a couple of features relative to this. One is the general volume going back to November of last year. So last year's corn crop gets harvested, start thinking about 2023. What's happening with new crop options. So regular December options are the blue bars here from November 15th to December 15th to January to February 15th. So earlier this week, you can see that the open interest in put options, farmers buying puts would be contributing to that volume increase. As you start thinking about the 2023 corn crop, buying puts, you can see that the overall volume for put options has increased. The open interest has increased from November through February, and the short dated new crop volume. So those not using or jumping right to the December contract, but using all the intermediate short dated new crop options. So this is the one that settles in March April, May, June, July, August, September, lumped all together, those volumes have increased, and the relative share of short dated new crop relative to regular options that all settle in December, that volume has gone up. So they're being used increasingly, and as a share of all new crop put option open interest, it's increasing as well as we're moving through the marketing year. So that's it on the open interest. I would just like to point out one or two more things, and then I'll let you off the hook with this. But we've got spikes and a lot of open interests shown here at different strike prices. Lots of puts are bought at $4, $4.50, $5 strikes. A lot of calls are bought at $7, $8, $9, $10 strikes. That's with the regular options. And a similar pattern shows up if you look at the different new crop, short dated new crop options. Here's just a open interest snapshot of at the monies, and you tend to see a lot of anchoring around $6 strikes for both puts and calls. But there is some open interest for all the different going across the top: March, April, May, June, July, August, and September short dated expirations. So growing, it's out there as another tool to perhaps use. And last thing with it is for both regular options, which are shown here, you've got an expectation that the volatility in the market, so implied volatility is here on the left-hand side, volatility will increase until we get through when the crop is made. So September is the peak in terms of where most of the volatility is, and that carries over into the short dated structure as well. This is all the short dateds. The last short dated has a late August expiration to it, and afterwards you shift to the 2024 crop year. So that same pattern shows up. What does that mean? Nearby short dated options aren't very expensive. If you go all the way out to September, you're buying most of the price risk for the full year, and they start to get pretty pricey or almost cost as much as a regular December expiration option. So something to take a look at, and just something that is related to the time of year here with crop insurance, and might be a tool to manage some other price risk going forward. There's my contact information, and I'll be quiet now.
Okay, thanks, Matt. Anyone have questions on any of the price points of the contracts or the basis discussion Matt just shared with us? You might have to run to class before the end of the session here today. So if you do have questions later, if you don't have his contact info, send me a note. I'll get that information to you, and we'll get your questions answered. So I don't see anything in the chat or anybody's. There are a couple of microphones unmuted, so if somebody had a question.
All right, I'll be able to follow up later, so thank you.
Okay. All right, so with that, Everett, I think we'll turn it over to you and take a little bit of a worldwide look at the current situation. So I can see your slide. It's in slideshow mode yet, but I can't hear you yet. Now I have your notes view.
Everett, you're muted.
Sorry about that. Okay. So I can do this to my other screen then, I guess. Mhm. Is this showing?
Uh,
Yeah, but it's not in presentation, right?
Not yet, no. And now we've got your notes view.
Yep. Stop share. How did we do this last time? Share. Okay, so screen 2. That should work. Is that better?
It's perfect.
Sorry about that. It annoys me when that happens to other people sometimes, and people spend 5 minutes on doing that sort of thing. And so, sorry about that. So I'm going to talk about now my thing. Okay, there it is. My arrows didn't work. So the economic implications of the war in the Ukraine, and as I started saying, is that this is not necessarily a professional interest, but more of a personal interest. I was born and raised in Europe, and my wife is actually from Poland, and so I sort of follow this news quite closely. But beyond that, I think it behooves all of us to kind of pay attention to this, because it does continue to affect agricultural markets. So I don't have a huge amount of time, so I will flip over the first parts of my presentation here fairly quickly. I want to talk about why we should care, put it in a bit of a context, and then how this relates to South Dakota agriculture, and talk about Ukraine's contribution to the world food production, and what the costs are to the global economy, and specifically talk about the Black Sea Grain Initiative, which is that agreement that allows Ukraine to export some grains and oil crops, and then wrap it up. So we should care. I think one reason is that I think there's a general agreement then that the global food crisis, the risk of that remains, and that so therefore supply disruptions are going to have an impact. Another reason is that it affects deeply some countries that are already stressed, in part because of the COVID situation. And so you see these numbers at the bottom there as to how many people are affected by this. And these are from the United Nations World Food Programs, these numbers that say that, close to 1 billion people face hunger. And of course, these people are living on the edge. And if supply disruptions continue because of the war, that's going to affect them. So we should care too, because of, some people say, so why should we spend the money? Why should we spend arms on trying to defend Ukraine? But history kind of shows us that sooner or later, these types of threats, they come at our own borders too. So you might as well try to nip it in the bud, so to speak, and deal with it now, rather than dealing with a much bigger problem later on, potentially. Of course, I'm an economist, so I'm interested in the economic aspects of this. So the war clearly has slowed the economic recovery that was on its way following, or still during the COVID pandemic, but it has clearly dampened economic recovery. Just quickly, we talk about the war in Ukraine, but it's not the only terrible thing that is going on in the world. Of course, we hear about the earthquakes that recently happened in Turkey and Syria, and then you see all these other threats that are out there here at the bottom. that I'm not going to pay a lot of attention to, but I just want to point out that there's lots of other issues that cause uncertainty in global markets potentially, and that are still out there. In fact, the International Rescue Committee, that's one of these organizations that provides help to refugees, and so they in fact list the war in Ukraine as a number 10 on the list, and there are lots of other problems. That's the point of all of this. So why should we care then, besides that this is a humanitarian problem? So agriculture is the ag sector is of course very important to our economy, and we depend very heavily on exports. And so about 40% of our ag commodities go for exports in the United States, and this war has been showing has had an impact in the sense that it has really destabilized markets, not only when it comes to product markets or commodities, grains and edible oils, but also when it comes to the fertilizer markets. Some numbers, that shows the extent of this problem. On the left-hand side, you see here the number of people affected by this in Ukraine, and then on the right-hand side, the economic cost. And it's, as we can all relate to, this is tremendous. And there's some estimates that show what it would cost to rebuild this economy, and these numbers are staggering. And this is, of course, besides the humanitarian cost. So the infrastructure is being destroyed, and that's going to have and already has a huge impact on Ukraine's ability to continue exporting their commodities. So why is this such a big deal? Well, they do have Ukraine, together with Russia, before the war, were exporting 30% of global wheat exports. They are also big operators when it comes to fertilizer, so that has an impact on fertilizer prices. And then a lot of the cooking oil in the form of sunflower oil was provided by Ukraine and Russia. So the three that are highlighted here are maybe the most important. And then, of course, oil markets, gas markets, and so on are not to be ignored also. So this is a bit of an old slide from last year, but it really shows the impact that the war had on the global economy to try to recoup, to try to crawl back from the global pandemic following COVID-19. And it was really a major setback for the world. That's what this is trying to illustrate. The hardest hit countries are of course those in Europe, and especially countries neighboring Ukraine, including the Baltic countries, Poland, Hungary, the Slovakia, and some other countries, Romania, and so on. And so those are directly hit, and they are hosting a lot of the refugees, as we hear about in the news. But countries worldwide have been affected by higher commodity prices that have really come down quite a bit in over the last half year because of that agreement that was made between the United Nations and Turkey and Ukraine and Russia, as that I'm going to be talking about later. So all of this, these higher prices, though, the prices are still elevated, and they have resulted in lower income, which is especially affecting people in countries that rely on these imports from Ukraine and Russia, particularly in African countries and East Africa and then sub-Saharan African countries, which then results in fears about these well, supply disruptions, and then affecting people when it comes to hunger kinds of things. As we know, in recent times, inflation has come down, but it's still, food prices remain elevated. Again, this is a slightly older slide also that shows that inflation increased in 2021, 2022, and but food prices remain elevated, as I already indicated. And this shows the Food and Agricultural Organization's global prices, which shows that yes, we're back to where prices were before the war started, but they're still historically high. So, and particularly when it comes to staple foods, they, the markets there remain tight. And so in local markets, these prices remain high. This gives a sense of where we are from a historical point of view. So when corrected for inflation, we see that prices are still almost historically high. And so that means disruptions, any additional disruptions in these markets are going to have a potentially detrimental impact on especially those countries that rely on these exports from Ukraine and maybe Russia also. So here's, I don't have to tell anybody, these are US food price inflation levels. And so that, while overall inflation has kind of come down from these high levels, food prices remain high relative to what they were a year ago. And these are recent statistics from 12 months ago, compared to 12 months ago. Fertilizer prices continue to be high, so that is going to have an impact on these things that some of the things that Matt just talked about when it comes to bases in South Dakota. So if we continue to see high fertilizer prices, which I would expect to be the case, then that's going to have an impact continue to have an impact on transportation. Here's some broad indicator of fertilizer prices, putting them in a bit of a historical context. And you can see that they're still quite high compared to what they were a few years ago. Related to oil prices, seems to have stabilized in recent times, but remains somewhat elevated. Diesel, you see that here, still high. So I talked about how this is affecting that there's still a high risk of food crisis that remains, and particularly in sub-Saharan African countries that are already facing tight budgets, and these countries are highlighted here in this slide. And I realize I'm rattling through these slides pretty quickly. I want to spend a little bit of time on how important and that how important it is that agriculture relies so heavily on exports in the United States, but we have come to realize that these exports can only take place in a peaceful setting. So sometimes people have been criticizing economics for saying that, well, as long as we trade with each other, peace will prevail. But I think the idea is really the other way around, is that peace can promote trade, and that globalization, this idea of being able to trade with other countries depends on having a stable environment. And that is something that maybe we took for granted for many years, but we sure have been reminded that we cannot necessarily take that for granted. So the having a stable geopolitical environment is critical, clearly for agriculture, as it relies so much on exporting a large share of its production here in the United States. So maybe let me talk briefly about the Black Sea initiative. So before the war, Ukraine had 18 ports, or before 2014, I should say, the year 2014, Ukraine had 18 ports, and then Russia invaded Crimea, and there were 5 of these ports there. They were already occupied by Russia at that time, and then during this war, 7 additional ports are in control of Russia, more or less. And so there's only 3 Black Sea ports left, and there's 3 on the Danube River. So the ability of Ukraine to export is very difficult with this reduction in these access and having access to these ports. And so at the bottom here of this slide, it shows that the Ukraine's ability to export decreased by about half or so, you can say. And the reason why Ukraine was able to export at all was because of that Black Sea grain initiative. So that was an agreement that I alluded to earlier between the United Nations, Turkey, Russia, and Ukraine. And it provided a corridor for Ukraine to be able to export by way of the Black Sea to the Bosporus, which provides access to the Mediterranean, so that then these commodities can be traded or sold across the globe. And so having access to the Black Sea is critical for these continued exports. And one of the reasons for why we have seen a decrease in global prices of wheat and other agricultural commodities is because of this agreement. So it was signed in July of last year, initially for 4 months, and then it was extended for an additional 4 months, and it's up for renewal in March 20th at the latest. And so big question is Russia going to continue or again be willing to sign on to this agreement, or does it want to change anything? In the meantime, Russia is already trying to actively and subversively undermine this agreement so that exports are slowed down with additional inspections and so on. So this corridor has led to a partial recovery of shipments from Ukraine, but not completely, of course. So then, as I already said, the impact on wheat prices is that, yes, it has brought down prices a bit, and people are not quite as nervous about the situation anymore, but that could turn around in a hurry if these countries cannot come to an agreement next month. So this is why we see prices at about the same level as they were a year ago. So the big question is Russia going to agree to renewing this deal? And in the meantime, it's not like it is all that easy to export these products from Ukraine in the presence of sea mines and all kinds of other dangers there. And then, of course, insurance costs have increased also. And what has happened also is that Ukrainian farmers have reduced their plantings of wheat last year, their sowings. And so their production of wheat is going to go down this year because last year they simply didn't get the prices for their crop that they had wanted to because of the increased costs to get their product to market. So overall, then, I think conditions in these ag markets, they remain very much unsettled, not just for Ukraine, but for the rest of the world also. And it's not going to take much for markets to get inflamed, so to speak, again. So there's going to be continued uncertainty in commodity markets in the foreseeable futures. So I put my contact information here if anybody has any questions. I know I had to go through this pretty quickly I know everybody kind of follows this Ukrainian situation in the news. And again, as I started out saying, I think it's probably good for all of us working in agriculture to take to keep paying attention to this, because it still has the potential to make changes to agricultural markets. Okay. Anybody have any questions?